Hello, I'm Robert Sears, Chief Investment Officer at Rathbones. One of the biggest challenges for investors today is separating signal from noise. Every day brings a new market narrative, be it interest rates, AI, elections, tariffs, geopolitics and volatility. Most of these dominate attention briefly before being replaced by the next concern. As investors, our job is not to predict every headline. Instead, our job is to identify the forces reshaping economies, markets and investment opportunities over many years to come. Looking across 2026 so far, I believe three main themes stand out. First, the AI revolution continues to drive one of the largest investment cycles we've seen in decades. Second, geopolitics has returned as a major market influence in a more fragmented and increasingly multipolar world. And third, we continue to adapt to a different investment regime, one where inflation and interest rates may settle at structurally higher levels than investors have become accustomed to during the previous 40 years. I'm going to show you four charts today that I think are different expressions of those very themes. Together, they explain not only what has happened in markets this year, but more importantly, how we are positioning portfolios for the years ahead. Let's start with artificial intelligence. Much of the market discussion focuses on a handful of technology companies and their share prices. But the bigger story is what is happening in the real economy. The chart we're showing now shows the enormous amount of capital that's being invested into AI infrastructure, data centers, semiconductors, power generation, and digital networks. The scale of investment is extraordinary. Companies are not simply talking about AI, they're actually spending on it. This itself is creating demand across the economy, from chip manufacturers and software developers to industrial companies building the digital infrastructure needed to support this transition. When we look back in 10 years' time, I suspect we will view this period not simply as an AI story, but as a major global productivity and capital investment cycle. In fact, the scale of spending suggests AI could fuel one of the largest boom-bust investment cycles of our lifetimes. That should not come as a surprise to us. History teaches us that every transformative technology follows a similar pattern, be it the railways, electricity, the internet. Each changed the world, but each also went through periods when investment and enthusiasm occasionally ran far ahead of reality. And importantly, something has changed this year. Markets are beginning to move from enthusiasm to evidence. The first phase of a technological revolution rewards participation. Simply being associated with AI was often enough to attract investor enthusiasm. The next phase is different. Investors are becoming increasingly discriminating. They want to know which companies can convert investment into earnings, which business models can generate sustainable returns, and which competitive advantages can endure. The key question is no longer who's investing in AI, it is becoming who will make money from AI, and that distinction matters. The long-term opportunity remains enormous, and the fundamentals remain supportive. But good investors do not wait for conditions to deteriorate before thinking about risk. As optimism rises, discipline becomes more important. As opportunities expand, selectivity becomes more important. And as valuations become more stretched in parts of the market, expectations become increasingly difficult to meet. The challenge is not whether to participate, the challenge is participating while ensuring portfolios remain resilient when markets inevitably move to extremes. But one of the most underappreciated features of this year is that equity markets have not risen solely because of optimism. They've actually been supported by earnings. The chart we're showing now shows how much of that equity performance has been driven by earnings and multiple expansion. And as we can see, it's mostly been earnings. Despite the concerns around geopolitics, inflation, interest rates, companies have generally continued to deliver resilient profits. That matters. Ultimately, market returns can only travel so far ahead of earnings. The reason equities have remained relatively robust this year is that many businesses continue to generate strong cash flows and healthy earnings growth. Artificial intelligence has certainly played a large role in driving growth and earnings, but so have resilient consumers, improving productivity, and strong corporate balance sheets. That is especially important in a higher rate world. When the discount rate rises, investors become less willing to pay for distant promises. Near-term earnings, cash generation, and balance sheet strength matter more. The key message is simple. Markets may occasionally become distracted by narratives, but over the long term, earnings remain the anchor. And today, that anchor remains reasonably firm. The third chart illustrates another defining theme of the year. Geopolitics is back. For much of the last 30 years, investors benefited from a world characterized by globalization, expanding trade, and relatively stable international relationships. That environment is changing. This chart shows oil prices alongside some of the recent major geopolitical events, including tensions involving Iran and disruptions to global trade routes. Oil is useful here because it is one of the fastest channels through which geopolitical risk can move into markets and economies, affecting inflation, consumer confidence, corporate margins, and central bank expectations. But the broader lesson is that investors increasingly operate in a world shaped by strategic competition, energy security, supply chain resilience, and rising defense spending. Iran is not the whole story. Iran is one example of a broader shift. We now live in a more multipolar world where geopolitical developments are likely to create more frequent bouts of volatility. That doesn't mean as investors we should react to every headline. Quite the opposite. It means portfolios need to be resilient enough to absorb the headlines without requiring constant repositioning. The objective is not to predict the geopolitical events. The objective is to ensure your portfolios can withstand them. We're coming to what I believe is the most important chart of this presentation. It shows interest rate cycles since the Second World War. So it's going back quite a long way, but it shows some important messages. The 3 decades after the war were shaped by rising inflation and rising rates. By contrast, much of the last 40 years, which is when most investors have had their working lives, was defined by falling inflation, declining interest rates, and globalization, acting as a powerful disinflationary force. Most investors now have come to regard that environment as normal. History suggests it may have been exceptional. Today, we're faced with a different set of forces. Governments are spending more, defense expenditure is increasing, supply chains are becoming less efficient but more resilient, the energy transition requires significant investment, and labour markets are tighter in many economies. All of these developments have the potential to create inflationary pressure, certainly until the productivity benefits from AI spread more widely across the economy. This doesn't mean inflation becomes permanently high, but nor does it mean that rates will continue rising, but it does suggest that inflation risk is likely to be structurally higher than it was during much of the previous 4 decades. If that proves correct, interest rates may also settle at higher levels than investors have become used to, certainly since the years following the financial crisis. For investors, that has important implications. Valuations matter more, income becomes more valuable, the cost of capital matters more, and broader diversification becomes increasingly important. Everything we've discussed today points to the same conclusion. The future is uncertain. We can be more confident, though, about the themes. We cannot be certain about the path. Artificial intelligence will continue to reshape economies. Geopolitical tensions are unlikely to disappear. Inflation risks are likely to remain higher than many investors became used to. What we cannot know is how those forces will interact over the next 6 months or even the next year. That uncertainty is precisely why diversification exists. At Rathbones, our approach is not to build portfolios around a single economic forecast. Instead, we seek to build portfolios capable of succeeding across a range of possible outcomes. In practice, that means combining quality businesses with durable earnings, exposure to long-term growth themes, thoughtful diversification across asset classes and geographies, keeping a valuation discipline, and finding alternative sources of return where appropriate. The objective is not prediction, the objective is resilience. The headlines will change, market leadership will change. Even the dominant themes we've been talking about will change. But one principle endures. Wealth is built by staying focused on the signal while others are distracted by the noise. The greatest force in investing is not prediction, it is compounding. Our role is to identify the long-term trends that matter, build resilient portfolios around them, and stay invested long enough for compounding to do its work. That is how we invest at Rathbones. Thank you.